Jeremy Grantham, this crash will change a generation. Grantham dives deep into the warning signs he sees brewing in the market. He'll explain why this crash could be unlike anything we've seen before and how it could reshape the world for a generation. Are you worried about your financial future, wondering how to protect yourself from the coming storm? Whether you are an investor, an economist, or just someone who wants to understand what's coming next, this video is a must-watch. Jeremy Grantham, a figure who embodies the spirit of Cassandra, the mythical prophet cursed to utter accurate but perpetually disbelieved warnings. Jeremy Grantham isn't your average investor. This British economist and co-founder of GMO LLC, an American investment management company, has cultivated a hawk-like eye for financial markets for over half a century. His track record speaks volumes. Grantham accurately predicted the bursting of the Japanese asset bubble in the late 1980s, the dot-com bubble's collapse in the late 1990s, and perhaps most notably, the US housing bubble that ignited the 2008 financial crisis. These prescient calls solidified his reputation as a financial Cassandra, whose dire warnings are often met with skepticism, but ultimately proven correct. Grantham stands in stark contrast to the current prevailing sentiment of bullish enthusiasm in the market. He argues that this very enthusiasm, fueled by recent economic trends, is misplaced and could lead to a significant correction in the form of an interest rate cut in the coming months. This seemingly positive maneuver, Grantham argues, could be a desperate attempt to prop up a market teetering on the brink of a major collapse. While headlines often emphasize the immediate triggers for market downturns, Grantham delves deeper, highlighting the underlying vulnerabilities that contribute to these crises. He emphasizes the unprecedented nature of the current situation. The cascading effects of global events like pandemics, geopolitical conflicts, and resource scarcity haven't been fully factored into market valuations. Furthermore, Grantham points out a historical pattern. Periods of excessive market optimism, often characterized by high valuations and unsustainable levels of leverage, tend to precede major corrections. The current market exhibits these same worrying signs, suggesting a potential bubble ripe for bursting. While an interest rate cut might initially appear like a boon for the market, driving prices upwards, a closer look at historical data reveals a more complex truth. To understand the potential consequences of this move, we must delve into the four major economic bubbles that plagued the United States in the last century: 1929, 1974, 2000, and 2007. In three of these instances, 1929, 2000, and 2007, interest rate cuts were implemented. These cuts did indeed lead to a temporary upward market swing. However, this seemingly positive development masked a far more sinister reality: negative economic fundamentals. The market surges were unsustainable bubbles, ultimately leading to devastating crashes. These historical examples starkly illustrate the dangers of relying solely on interest rate cuts to prop up a market with underlying weaknesses. The sole outlier in this pattern is 1974. Here, a significant market rise occurred after a period of decline, seemingly coinciding with the first Federal Reserve rate cut. However, it's crucial not to let this single instance overshadow the larger trend. The disastrous consequences of the 2000 and 2007 bubbles, both preceded by rate cuts, are a stark reminder of the potential pitfalls. Furthermore, Grantham highlights a critical investor behavior, a tendency to ignore historical downfalls and maintain a bullish outlook. This misplaced optimism often leads to significant losses. Investors must be wary of this cognitive bias and approach the market with a healthy dose of skepticism, especially when faced with seemingly positive news like a rate cut. Grantham's message is clear: the current financial crisis is not over. He warns of a potential Phase 2 stock market crash looming on the horizon. However, he doesn't leave investors completely in the dark. According to an article he wrote for GMO, there are still alternative assets offering attractive returns and value propositions. By understanding the historical context of interest rate cuts and acknowledging the potential for a market correction, investors can navigate the current economic climate with greater awareness. Taking heed of Grantham's warning and exploring alternative investment options can help investors mitigate potential risks and position themselves for a more secure financial future. Jeremy Grantham offers a cautious outlook on the market, acknowledging progress but warning of further challenges ahead. Well, the first and easiest leg of the bubble burst he predicted a year ago seems to be unfolding. With speculative stocks taking the brunt of the initial decline, Grantham believes the real complexities are yet to come. Current valuations, though reduced, remain above historical averages. However, history suggests these valuations could overshoot on the downside as economic fundamentals deteriorate. This outcome is highly likely, but the exact timing and severity of the next decline are shrouded in uncertainty. The ever-changing global landscape throws a wrench into precise predictions. Several factors could potentially delay or even pause the bear market. The changing political climate with a new presidential cycle on the horizon, the unexpected strength of the labor market, China's economic reopening, and a possible subsiding of inflation. However, the key factor for the next 12 to 18 months, according to Grantham, lies in the ongoing health of corporate fundamentals. A significant deterioration here could trigger the next market decline. Grantham advises long-term investors to remain vigilant on several fronts. Interest rate changes pose a potential threat, and a downturn in the global property market could have serious repercussions for the broader economy. Additionally, the ongoing crisis between Russia and Ukraine casts a long shadow of uncertainty. The ongoing conflict between Russia and Ukraine casts a long and uncertain shadow over the global economy. While the full impact remains unclear, the immediate consequences are already evident in the form of disrupted supply chains, particularly for essential commodities like food and energy. This disruption disproportionately affects developing nations surrounding the conflict zone, creating economic and financial vulnerability. Investors, by nature, are averse to uncertainty, and with good reason. Uncertainty often precedes negative outcomes, leading to the chilling term polycrisis, the simultaneous occurrence of multiple catastrophic events. Jeremy Grantham warns that even a single event spiraling out of control could trigger a severe global recession, potentially dwarfing the devastation of the 2008 financial crisis. One potential catalyst, according to Grantham, is a bursting housing bubble. Unlike the recent decline in equities, a real estate correction would likely be much more severe and prolonged. Unlike stocks, real estate doesn't readily adjust to changing market conditions. This characteristic makes it a lagging indicator, meaning its decline often follows a broader economic slowdown. Furthermore, real estate is intricately linked to other sectors, particularly construction and related industries. A real estate market downturn would have a domino effect, triggering widespread economic weakness. Grantham identifies the middle class as particularly vulnerable, and many rely on the value of their homes as a key component of their retirement plans. A decline in housing prices could severely impact their financial security. This threat isn't merely theoretical. Australia and Canada, previously considered to have stable real estate markets, are already experiencing a decline in housing prices. This trend serves as a stark warning of the potential domino effect a global housing collapse could trigger. Grantham's warning of a polycrisis, potentially triggered by a bursting housing bubble, underscores the need for heightened awareness. Investors and policymakers alike must remain vigilant and prepare for the possibility of a severe economic downturn. A 12% drop in Canadian housing prices over the past year, reported by Reuters, paints a worrying picture. And Grantham suggests similar declines could plague other overvalued markets. He delves even deeper, factoring in the recurring influence of presidential cycles on market performance. Historically, as Grantham points out, the 6 months between October of the second year and April of the third year in a presidential cycle have yielded meager returns compared to the rest of the cycle. His warnings, coming from a seasoned investor like himself, serve as a valuable reminder for us to remain cautious and explore alternative strategies during these challenging economic times. Hope you liked the video, then do like, share, and subscribe to our channel.